Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, guys, I want to welcome back a guest that we've had on. It's been a number of years now, Keith Weinhold. I went back to look at the last episode we had him on. I think it's been about 4 years. So, 4 years ago, the world was in a very different state. It was a very different time, and so thankfully we're out of the COVID era and on to newer and greater things. So, for those that don't know Keith, he's the founder of Get Rich Education. He's the host of the popular Get Rich Education podcast. And he's a longtime thought leader in the real estate investing space, and like myself, Keith was also born and raised in Pennsylvania. For those that don't know, I was born and raised in Harrisburg, Pennsylvania. Keith, I believe, a couple hours away from where I was, but for many years now, Keith has made Alaska his home base. Keith has very much a unique perspective on wealth building, debt, and really the housing market as a whole. And today, we'll be diving into everything, from why the property itself, this is something that Keith kind of coins, why the property itself is less important than you think, to how the housing crash has already happened in a way that most people don't even realize, to the role inflation and debt play in building long-term wealth. And so, again, it's been a number of years here, so I'm excited to welcome Keith back here. So my friend, Keith, welcome to the show. It's a pleasure to have you back here again, my friend.
Oh, Kevin, it's good to be here and be in the auspices of another fellow native Pennsylvanian as well.
That's right. That's right. Yeah. No, PA's rocking and rolling. As I think I told you this little tidbit last time. Every time I speak with someone from Pennsylvania, they never know this, but I'm going to share this fun fact that you already know, Keith. I'm going to share it with the rest of the listeners here today. Pennsylvania, those that are born and raised there, it's the only state where if you're from Pennsylvania, you refer to it by its initials, and you assume that everyone else, everywhere else across the country, they know what you're talking about when you sound from PA. And that's the only state that does that. So I think it's pretty neat.
That's right. No one else does that. No one else says I'm from TN if they're from
No,
Memphis, right?
they don't. They don't. So with that, my friend. So it's been a number of years since we had you last on here. Let's start with just let's back up a little bit. What have you been up to? I mean, what have the last few years looked like for you? Where have you been spending your time, energy, and efforts? Obviously, it's we've gone through quite a bit of turmoil over the last 5 years, and would love to just get an update as to what's going on in your life.
Well, one of the big words in real estate investing, we all know it. Even the person that cuts your hair and cleans your teeth knows it, and that's affordability. Really, affordability has been under fire, under pressure. By a lot of measures, we have the worst affordability for home buying since the early 80s when the
Hmm.
Jeffersons was on television. So it's been helping a lot of people deal with that. It's really the effect of three things: general inflation, higher home prices, and higher mortgage rates. Really, those three things. The crux of the problem, it's not exactly inflation. Really, it's the fact that over the long term, wages don't keep up with inflation. And really, that's the crux of the affordability problem. So I've been helping people deal with that and put that in perspective, really, Kevin.
What does that mean for investment real estate? I mean, are you still doing deals? Are you seeing deals still get done by your students? I mean, what's your world look like?
Yeah, I mean, I think you're asking, how many deals are taking place. One way to measure that on a national basis is existing home sales. Existing home sales have been down substantially. And when a lot of people hear that, they think prices. Oh, no, we're not talking about prices. We're talking about existing home sales. That means sales volume. That means the amount of overall transactions. So to give an idea, of a real estate market, a residential one that's become pretty lethargic and not very vibrant, is that sales volume. It had its recent peak of about 6 million home sales back in 2021. I mean, 2021 was crazy, kind of the crux of the pandemic. Kevin, that's when for an open house, you saw cars wrapped around the block for just one open house. Okay, well, that year, 2021, there were 6 million existing home sales. Today, we're on pace to do about 4 million. And we also did only about 4 million last year. So if you put that in perspective and think about what that means, prices have stayed stable, but that's a 33% reduction in transactions. So investors, people like you and I, Kevin, We're not as affected by this as some other industries, but think about the mortgage loan industry. If you're doing
Yeah.
33% fewer transactions, think about the hard decisions companies have to make and lay people off. 33% fewer transactions for title companies. It's probably close to 33% fewer transactions for furniture companies as well.
Mhm.
So really, it's both affordability that's been a problem, and that's led to this relative lethargy, kind of a slow, not very interesting residential real estate market, at least from the transaction perspective. Really, really slow.
But could one not argue? And I don't know the data points, Keith. I guess what did it look like? 2021 was kind of the peak. I think you'd referenced 6 million units a year
Yeah,
transactionally. What did it look like prior? What was a more normal year like? And maybe 2020 wasn't a normal year either, right? Because a lot of folks thought the world was ending for a period of time. 2019 maybe. Just again, trying to find maybe a better baseline to use, and then does I guess in my mind, and I don't follow these data points as much as you do, is that maybe 2021 was, somewhat artificial inflation, right?
it
Lots of
was.
money pumping into
Yep.
the marketplace, and ultimately we had to get back to a sense of normalcy at some point in time. And so, are we at a place of normalcy, or are we still behind the eight ball a little bit?
We're still behind the eight ball a little bit. 5 million is more of a
Okay.
normal long-term number. But yeah, I mean, if we've got 4 million, now that's, 25% less still than 5 million, sort of this long-term normalcy rate of existing home transactions. And if you're a careful listener, you notice I've been using the word existing.
Hmm.
That doesn't include new build. So, when the listener out there reading headlines, always look at that closely. Are we talking about existing or are we talking about new build? You can learn a lot from that. When you introduce new build data, that introduces an awful lot of noise. For example, even when we look at prices, sometimes we want to exclude new construction. So why is that? Why do we want to focus on existing a lot? Well, because new build can introduce a lot of aberrations to the market. For example, the size of new build properties has dropped substantially the past few years. Again, coming back to the central theme of affordability to help make a home more affordable. So we're not looking at same when the square footage of a property drops a lot. And also another thing that's been happening as a response to the lack of affordability is you have more builders building further and further out from a central business district where there are lower land costs for that new build property as well to help meet affordability. So the takeaway is, yeah, we want to be careful when we look at numbers. Are we looking at existing? Are we looking at new? Or are we looking at overall properties?
Do you believe that if rates come down, I mean, really, is that the lever that has to be pulled in order for that transactional volume to kick back up and make homes more affordable for the average home buyer?
Yeah, it's certainly going to help. I mean, really, lower rates is the most likely significant lever that can help with the affordability crisis. Prices are pretty firm. Home prices are up 2% year over year. It's difficult for home prices to fall. In fact, home prices have only fallen one time substantially since World War II. A lot of people don't realize that. So home prices are firm. I expect them to stay firm. And then the other lever is if we would get a huge surge in wage increases, which I really don't expect anytime soon unless we have another really big bout of inflation. So to your point, yes, lower mortgage rates, like that's the biggest lever that can help affordability return. And to speak to mortgage rates, Kevin, and help put all of this into perspective, including this affordability component, is the fact that today mortgage rates are low. And that gives a lot of people pause. They're like, what are you talking about? Mortgage rates were 3%, even as low as 2 point some percent, just as recently as 2021 and early 2022. What are you talking about? Like mortgage rates are 2x to 3x that today. We look at a long-term perspective when we look at the arc of mortgage rates in setting up expectations where we think rates could go, and we need to look at a frame of reference. Mortgage rates peaked over 18% in 1981. That's if you had a good credit score and everything on a 30-year fixed rate mortgage. That's what we're talking about here. In fact, Freddie Mac, they're the ones that have the best, most reliable stat set for mortgage rates. And that goes back to 1971. The average mortgage rate since 1971, all the way up to today, through all these presidential administrations, Nixon and the Reagan years and Clinton and the Bushes and Obama, everything, up to today, from 1971 until today, the average 30-year fixed rate mortgage is 7.7%. So that's why I talk about how mortgage rates are, moderate to a little low today. That takes a lot of people back. I don't see any impetus that's going to get us back to, say, 3%
Yeah.
mortgage rates. So some real perspective here.
Yeah, no, and the interesting thing, again, you might have data points on this to see is a lot of the lack. Do you feel that a lot of the lack of transactional volume is also related to those folks that have locked in, 3%,
Yeah.
mortgages, right? Like they why would they sell and ultimately trade into a upgrade of a home, but ultimately be paying significantly more than that of what they're paying at the present time, double the cost of capital. Rates today, 30-year rates are where in the 6.5, 7% range. I don't follow it, but
Yeah, I mean, as of today, 6.3% is where they're at.
okay.
But yeah, you have a lot of those homeowners locked into low rates. I mean, first, if we just pull back and look at the overall homeowner landscape, 4 in 10 have a paid off property. So
Mm,
just to talk to those about the other 60%, that percentage that are mortgage borrowers, among borrowers, 70% still have a mortgage rate under 5%, meaning it starts with a 4 or less. So yeah, you're bringing up astutely, Kevin, the lock-in effect. People are less reluctant to sell and give up that rate to trade it for a higher rate. And here's what's interesting. A lot of people, if they couldn't make the payments on their home, and say they lost their home, something that actually happened a lot in 2008 when people were locked into unsustainable mortgages because they didn't have good credit and they didn't have good income. The borrower is in good shape today. But even if for some reason they couldn't make the payments on their home and they lost their home and they had to rent, rents are actually higher in many cases than what that mortgage principal and interest payment is. Maybe even the mortgage principal, interest, taxes, and insurance that they pay today are lower than what comparable rent would be. And this helps stabilize the housing market. People are really motivated to make their payments, and they can easily do it when it is so low, speaking to that lock-in effect. And we're bringing up another reason now why transaction volume is so low, that lock-in effect. So homeowners are in good shape, their payments are sustainable, they don't want to sell, and they're just staying put, they're staying in place.
Tying that all back around, Keith, what does that mean for us real estate investors? I mean, is there still good value out in the marketplace? I mean, is the rent to value ratio still, is there good opportunity to be had as far as ROI for an investor that wants to buy into a residential investment or a multifamily investment or, anything related to that of residential housing?
Well, the deals in the 1 to 4 unit space, single family homes up to fourplex buildings, yeah, just are not as good as they used to be. The ratio of rent income to purchase price is lower than it was 5 years ago. And that's so simple, but that's just really the simplest formula for profitability for a real estate investor. You don't have to look at cap rate or NOI in the 1 to 4 unit space. Let's just look at that ratio of rent income to purchase price. 20 years ago, it was easy to find a full 1%, meaning on a 200K property, you could get $2,000 worth of rent income. That's that 1%
Mhm.
ratio. But now, oftentimes, you've got to find something that's more like 0.7%. That would be a $1,400 rent on a 200K property. So that simple formula, and I love that, the rent income divided by the purchase price. When I'm looking at properties, when I'm scrolling or scanning, like that's a calculation you can do in your head. It's only if I would see a ratio that appears really good, oh, that I would like drill down and look at that property more closely. So, of course, when you have something that's that simple, though, rent income divided by purchase price, There's a lot of things that doesn't tell you, what kind of mortgage interest rate can you get? What kind of property tax do you pay in that jurisdiction? But really, I love the simplicity. That's it. Rent divided by price, but it has been under attack. Now, today, I still don't know where you're going to get a better risk adjusted return
Mhm.
than you do with a carefully bought income property with a loan. I've always liked fixed interest rate debt. The best risk adjusted return anywhere. I really don't know of a better one than with buying real estate, because real estate investors have
Agreed.
so many profit centers, five simultaneous profit centers, which few people understand.
Yeah. So using that, I want to unpack the 1% rule a little bit for those that aren't familiar with it. And again, there's a lot of variables there, as you had mentioned. Mortgage rate, taxes, insurance, and that respective market that you're buying in. And so, what what are you really trying to back into when applying that rule? Is there a true cash on cash return that you're hoping to achieve? Again, assuming all these other variables that we just don't know what they are at this point. Um, is there a target range of actual ROI that you're actually looking to achieve when applying that 1% rule?
No, I'm just looking for any positive cash flow,
Okay.
to your point. Yeah, there's nothing like the cash on cash return needs to be at least 3.5% or something like that. But yeah, I still like buying a property that's greater than a break even. Inflation is probably going to increase your cash flow over time, even if you bought a property that broke even or just had a trickle of cash flow or a $100 cash flow today. A lot of people don't understand that fact, that right there. You can't count on it. You shouldn't count on getting rent increases, but we all know it generally happens over time at a rate of about 3% a year, but it actually increases your cash flow. If you increase your rent 5%, your cash flow can often increase something like 12%. Why is that? How could that happen? That's because, it's key for the person that was listening closely. You get fixed interest rate debt. So your rent income goes up, your expenses increase, except for that mortgage principal and interest. Inflation can't touch it. It's kind of like a mosquito buzzing against a window and always trying to get in, and inflation can't touch that. In a way, it's sort of like debt that's an asset in some unusual way, or some play on words, getting that debt. So yes, you can't count on rent increases over time. We know what typically happens, and that's really part of the compelling value proposition of buying income property with a loan. You're sort of leveraging inflation. You're really on the right side of it.
Are there any particular markets that you feel are ripe for opportunity today where you're spending your focus and energies in?
Yeah, it's still in high cash flowing markets like Memphis,
Okay.
Little Rock, and a good part of the Midwest. And the Midwest still has home prices appreciating faster than the national average as well. So those are some of the areas that I like. Those jurisdictions also tend to have laws, as your listeners might know this already, Kevin. They tend to have laws that benefit the landlord more so than the tenant, where you can get a prompt eviction. But those are still the areas where you do get that high ratio of rent income to purchase price. On a single family rental home, you might still find 0.8%,
Okay.
meaning $800 worth of rent for every 100K of property purchase in places exactly like that.
I was hoping that you'd tell me the 1% rule is applicable in those
Ah,
markets, but
it's
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 tough.
pretty rare. If you do see if you do see a property that has a full 1% rent to purchase price ratio, it could be in a sketchy area. You need to
Yeah.
make sure that you can actually get the rent in like you would get a respectful rent paying tenant in there. That's something that we would have to look at more closely.
Have you explored building new product? Is there an opportunity there getting at a lower basis by building ground up?
You asked such a smart question. This is actually the first time ever, as long as I've been an active real estate investor, Kevin, for more than 20 years, where new build purchases for income property make more sense than existing purchases. Why is that? It's because builders know that investors and borrowers are struggling to buy and afford property and make the numbers work, like you're talking about. that builders are incentivized to buy down your rate for you, to buy down your mortgage rate. We deal with a lot of providers that buy down your mortgage rate to 5% or less for you.
Hmm.
And this is a fixed long-term loan in order to help get the numbers to work, especially where you might see a new build property where the rent to purchase price ratio is less than 0.7%. And it's just like, the numbers wouldn't work paying a higher mortgage rate. But some are willing to buy them down to as little as 4.5. However, if you're looking into buying a new build income producing property, you do want to look at that closely. Who is paying for the discount points to buy down the rate? Is
Yeah.
it the builder or is it you? Because some builders just suggest, hey, you can buy down, you can have your rate bought down. But yeah, the next question is, yeah, okay, who is actually doing the buy down?
Yeah, I mean, it's just getting tacked on. I mean, in that instance, I'm assuming that a lot of it's just getting tacked on to the back end of the purchase price, or it's being baked into closing costs somewhere. Somebody's paying for it more than likely. The borrower is paying for it. Is that again? I'm sure, I'm assuming we probably have that here in Florida. Again, I don't really follow the residential market too much, but there's, as you had mentioned, like kind of on the outskirts of Tampa, the tertiary, not necessarily tertiary, probably more secondary areas. That's where a lot of the builds are happening. Lots of these, planned subdivisions, hundreds and thousands of homes being put up. And my understanding through the grapevine is I hear that their, sales volumes is incredibly slow. And a lot of these builders are now offering some creative loan products, again, to what you've just stated there, to attract not necessarily even just homeowners, but also investors to come in and buy their product from them. Is there a real opportunity there though? I mean, have you seen investors be able to benefit from buying brand new product at a fair price, with economics at work, keeping it as a rental?
I have. And Florida
Yeah.
has some builders that are almost desperate. I'm a
Hmm.
longtime investor, personally, directly in Florida income property. Southwest Florida, places like Cape Coral, they have been
Yeah.
ground zero for real estate depreciation, a contraction in real estate values year over year of 10% or more in some Southwest Florida markets. So, like the post pandemic migration boom is certainly over in Florida. Kevin, as little as 10 years ago, people used to talk about buy in Florida. It's cheap. It's sunny, cheap, and cheerful. Like you would sort of hear that sort of thing about Florida real estate. That is no longer true.
No.
Florida just is not as cheap as it used to be. It's the same or higher than the national median home price now in Florida. So, yes, some builders are rather desperate. The other benefit of buying new build, especially in a place like Florida, where a lot of new building has taken place and the supply actually exceeds the demand here in the short period, you can take advantage of that not only by getting the rate buy down, but because homeowners insurance premiums are substantially less on new
Yeah.
build property because they're built to today's wind mitigation and other standards than they are existing property. I have a friend that just bought a new Florida duplex through us in Ocala, Florida. That's sort
Hmm.
of north central Florida.
Yeah.
On that new build duplex that he paid 400K for, I saw the actual insurance premium, the rate sheet, $694, 694.
Wow, it's cheap.
So the benefit of buying new build is you get a lower insurance premium. You get these rate buy downs, sometimes what your builder will buy for you, make for you rather. And of course, you're probably going to have low maintenance costs for a long time
Yeah.
since it's a new build property. And you get a tenant that is probably going to stay longer than the average duration. They're the first person to ever live
Hmm.
there. It's difficult for the tenant to improve their housing situation when they have a new build income property unless they would go out and buy. And it's a very difficult time to go
Yeah.
out and buy. So, due to that lack of affordability, really the advantage for a real estate investor is tenants are staying put longer. The
Mhm.
average tenancy duration is up because they can't run out and be a first time home buyer.
Yeah, that even trickles down to the space that we're in. We're in the mobile home park space, and while we don't have a lot of rentals inside of our portfolio, most of our residents own their home and they rent the land. But throughout our portfolio, we have I think roughly 400 units that we own that we have as standardized rentals. And we've noticed that trend as well. Historically, 10 years ago, we track actually about, I can take it back about 8 years where we actually have data to support this claim, is that our average renter would stay about 16 months. That was fairly standard. Whereas today, um, it's nearly 3 years at this point in time. The
Wow.
majority are staying nearly three. And there's some variables in there. 8 years ago, we weren't bringing a lot of new product into our communities, whereas a lot of the mobile home parks that we purchase today do have a lot of newer mobile homes in them. So again, to your point, it's a newer home. It's fresh. There might not be the first person that lived there. Maybe they're only the second, right? But it's still a very new home. It's only a couple of years old. All the appliances are new. It's fresh. It's well insulated, and it's just a high quality product. But it's nearly double of what we used to experience and what we used to
Great.
underwrite. It's which is interesting. You know, I want to circle back. You'd mentioned Cape Coral. I've got quite a bit of experience with Cape Coral. This is not the first time that Cape Coral and Port Charlotte and those areas have crashed. I mean, like they've got quite an interesting history in time. Back during the GFC, that area down there took probably one of the biggest hits in most of Florida. While the rest of Florida got pounded pretty hard with home values and decreasing home values, decreasing rents. Port Charlotte, Cape Coral, and those areas as well. It's just, and it looks very different down there today. As far as the job basis, I mean, there's a little bit more of a an economy than what existed maybe 10, 15 years ago. But I don't know if you know the story of Port Charlotte. There's some interesting history that you can, if you want to spend some time, go on YouTube. There's some documentaries out there about basically when that area was created. There's two brothers that essentially subdivided and sold swampland and sold the dream to the Northeasterners to come down and buy parcels of land down in Cape Coral, Port Charlotte, and in that general area. And it took a lot of time for it to develop over the years, but it's a beautiful area down there. But again, I think what happened, to your point, a lot of folks during the COVID era were wanting to come to Florida. We were fairly free down here. The sun was shining. The Gulf of Mexico was warm, and that was a good value for a lot of folks. The values were driving up. There was home inventory down there. You got a good bang for your buck back at that point in time. But again, there's not as much as many amenities and a supportive economy there in that immediate area like you might find in the Tampa area, or you might find in Orlando, or even Ocala. Ocala is a phenomenal market right now, and
Yeah.
Ocala is that, for those that don't, you mentioned, you referenced the insurance there, which is that's a great price for that policy. $700 a month, basically. That is inland. For those that don't know the geography here in Florida, that is inland. So you are fairly protected from storms, hurricanes and things of that nature, which crush us here on the Gulf Coast. But in any event, I just thought I'd share that. There's some pretty cool documentaries out there in Port Charlotte and the whole area down there. But beautiful part of the country. But just it's suffering right now. I was looking the other day on Zillow. I just play around and check and see what waterfront home prices are going for. And down there, you can basically get a canal front home going out to the Gulf of Mexico for about $500,000, which was probably closer to 800,000 during the boom era of 2021 and 2022. So historically, we used to buy properties down there. This is back in 2003, 4, 5, before the GFC. We could buy those same properties for 150 and $200,000.
Gosh.
Waterfront homes, deep water canals going out to the Gulf of Mexico. But when it crashed, some of those homes were selling for $120,000, $100,000. So it's interesting to see how things have come kind of full circle multiple times. Not just down there, but in all of Florida as well. Florida's always boom and bust. I think they say that with, and you could probably speak to that. Most of these coastal towns, whether it be in Florida, whether it be up the eastern seaboard, the coastal markets are definitely more of a roller coaster ride than the Midwestern markets where you invest in. Would you agree with that?
Yeah, I would. And yeah, you talk about Florida being a boom and bust, and what you said is certainly true in the shorter term. Back in the global financial crisis, we saw more price bloodletting in Florida than we did in other states as well. But over the long term, the
Yeah,
long arc, I'm bullish on
I am
Florida
too.
because of just the obvious constant in-migration story. In fact, if you go back to decennial censuses all the way back to the early 1800s, every single decennial census, every 10 years, the population of Florida has rose, and it rises faster than the national average almost all of those 10-year periods. So yeah, over the long term, I certainly like Florida. But yeah, you sure can, nitpick over the short term. But as little as 5 years from now, if you bought today, as little as 5 years from now, I could see someone saying like, "Yeah, I bought back 5 years ago because we're actually in a short-term overbuilt condition, and builders
Yes.
bought down my rate for me." This could look savvy and this could look wise. So if you're looking for opportunity, new build in Florida is definitely something to look into.
I agree. No, absolutely. Like the long term, opportunity here in Florida, it's there. It's interesting. We get these hurricanes every year. Last year was a pretty impactful year, at least here on the Gulf side. And the neighborhood I lived in, we got flooded. Luckily, our home's a newer build; it's built up. But 70% of the neighborhood I lived in had 4 or 5 feet of seawater in it, as did the long stretch of the Gulf Coast here. And it was the first time this area has ever this immediate area, right where we live, has ever had it wasn't even a direct hit. It just happened to be a massive storm surge. But it was, catastrophic as far as the damage that it did. And a lot of folks that we knew in our neighborhood here lived here for 10, 20, 30, 40 years, 50 years, and they had never had any flood water whatsoever. And there was two camps where they fell in. Either one camp where whether they had the money to rebuild or not didn't matter. Like mentally, they were never going to deal with that again. They were moving away. Like they don't want to go through the heartache of that again. And the second camp were basically, I knew it was going to happen at some point in time. This is the kind of price to live, to pay to live in paradise.
Right?
And what ultimately occurred is, you saw homes going up for sale, and the initial chatter for those that were impacted is that who's going to buy that? They're not going to get hardly anything for it. It's just like, who's going to want to live here now that it's been flooded? I said, just wait. I say, us as human beings have short-term memories. We do. And I can promise you within a few months, those homes will be gobbled up. Some will be knocked down. Some will be rebuilt. But inevitably, the prices will come back incredibly strong, and you'll see very limited inventory, at least in the desirable markets that are here on the water. And that happened within 6 month period of time. Prices are back up. You can't get your hands on a flooded property now, or one that had been flooded.
Right. I can believe it.
It's
And this is not the way that you want to have a waterfront property when the water
no,
inundates you
no,
and comes to you. That is not the way to buy waterfront property.
yeah. Interesting, but no, Keith, this has been a fun conversation, my friend. So let's talk about, I'd like to peek inside your brain. If you were going to start all over again from scratch, you've been at this now, how long? Almost two decades. It's been quite some
Yes,
time,
yes.
right?
More than 2 decades. Is that what you're asking? How would I start
Yeah,
again if
I
I were
started from
starting from
scratch
nothing?
today. Yeah, like what would you do? Where would you focus? What asset type, and any particular strategy outside of what you're doing today? Where would you focus your time?
Actually, it is quite a coincidence. The way that I would start all over again in real estate is the way that I did start in real estate. It worked out phenomenally. In a way, it makes sense because if it hadn't worked out phenomenally, you never would have heard of me, and I wouldn't have become this, real estate, thought leader or whatever. Because this is a way an everyday person with virtually no real estate knowledge and very little money can start out. What I did is I made the first ever home of any kind a fourplex building where I lived in one unit and rented out the other three. This is something very actionable for your audience
Yeah.
as well, Kevin. Or if maybe you're a listener that has an adult daughter or son and they want to get started in real estate with a bang without much money, is to buy a fourplex just like I did. You can use an FHA loan, a 3.5% down payment. You have to live in one of the units at least 12 months. And at last check, your minimum credit score only needs to be 580. Now, you will get a
Wow.
lower interest rate if you have a higher credit score, but those are the only three criteria you need. I mean, what a country. Talk about the American dream. You can use that FHA program with a single family home, duplex, triplex, or fourplex. That's the formula. That's how I began. Actually ended up living there a little more than 3 years. But what that did for me was remarkable. And in fact, you know what it taught me, Kevin? And every listener can benefit from this. It's paradoxical. A lot of times I say things that you would not expect to hear that make you go, wait, what? Whoa, how can that be? Is what it taught me is that I don't want to focus on getting my money to work for me. You probably wouldn't expect to hear that.
Hmm.
It's actually a middle class paradigm to say, well, I don't want to work for money. I also want to get my money to work for me. I'm telling you that that's going to keep you middle class or worse. That's going to keep you working until old age and you won't have an outsized life and retirement and options. If you think that the best and highest use of your dollar is getting your money to work for you, it's not. What's the paradigm shift that this fourplex building taught me? The way I started out, which is still the way that I would start out today. And you probably heard this before, but I'm going to put a new twist on it, is you want to ethically get other people's money to work for you. And we can be ethical. We can do good in the world, provide housing that's clean, safe, affordable, and functional. Never get called a slumlord that
Hmm.
way. You can employ other people's money three ways at the same time ethically by buying an income property with a loan like we've been talking about in Florida or with this fourplex building. How do you do it three ways at the same time? Using the bank's money for the loan and leverage, which greatly amplifies your return beyond anything compound interest can do. The second of three ways you're ethically employing other people's money is you're using the tenant's money to pay for the mortgage and some of the operating expenses on this fourplex. And then the third way you're simultaneously using other people's money is using the government's money for generous tax incentives at scale. So the lesson is that the best and highest use of your dollar is not getting just your money to work for you, it's other people's money. In this case, the banks, the tenants, and the governments. That's what you can do. I mean, what an opportunity. A lot of people just don't even
I
know
love it.
about that FHA program.
Yeah, I wasn't aware that it was that low of a down payment, Keith. I had
Yeah,
no idea. 3.5%. You said a 550 credit score, I believe, minimum.
580 minimum credit score.
580. Gosh.
And you have to, thirdly, you have to own or occupy a unit
Yeah.
for at least 12 months. And hey, I'm not saying it's always easy. You know, you got to think about that. Your neighbors are also your tenants. And I don't know how to fix stuff. I still don't. I'm a terrible handyman, but it's good to learn a little about human relations and, finding a gentle way to let the tenants know that you have a mortgage to pay every month. I mean, just that alone can help them ensure timely rent payments. But and this also doesn't mean every area or every fourplex building is good, but yeah, that's the opportunity. That's how I started. I would totally do it again.
Can you use that FHA program more than once, or is that just the one time, your first primary home purchase?
It's generally you can only use one at a time.
Okay.
There are some exceptions, like if you and your job move like a certain mile radius away from where you got the first one. But yeah, generally it's only going to be one at a time. A lot of people don't use it, don't know about it. In fact, if you have VA benefits, Veterans
Mm,
Administration benefits, you can get a similar program like I was talking about, but zero down
zero.
payment
Yeah.
rather than 3.5 with an FHA loan. It's a really good,
I
amazingly
didn't know
good
that.
opportunity.
That's incredible. That's incredible. Well, Keith, my friend, I appreciate you coming back on. It's always good to catch up with you. Good to see that you're doing well, healthy there in Alaska. You guys are entering winter here soon, aren't you? Is it snowing yet up there? It's October. So October 1st, as we record this.
Yeah, I am in Anchorage, Alaska today. The first snow that sticks typically hits around November 1st,
Okay.
something like that.
That's a little later than what I thought. A little later than what I thought. So, my friend, I appreciate you coming here today. For those that want to learn more about you and follow you and check into everything that you have going on, where's the best place to find you?
Yes, to listen to me on the Get Rich Education podcast. I think a little similar to you, Kevin. I've been delivering a weekly show. I mean, every single week since 2014, no exception, never missed a week. We don't replay old episodes. You get a lot of monologues, a lot of me talking to you like this for about 40 minutes. And when we have guests on, we also have really prominent guests. Like, for example, Robert Kiyosaki's been a guest on the
Mhm.
show 4 times. I'm breaking it down every week on the Get Rich Education podcast. I'd love to have you as a listener.
Fantastic. Well, appreciate you, my friend. And guys, we'll put all that in the show notes, and that's all we have. So let's catch up again here in not 4 years from now, Keith, and let's make a little bit shorter time frame.
Let's do it. Thanks, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.